Sahai is joining us. He is head of equities and fund manager at HSBC Global Asset Management. Neelotpal, hi, good afternoon. Thanks for joining us. We've seen a very sharp rally from the lows, but the last couple of days have been a bit rough. Your thoughts on how the market's position, just in the near term?
Thanks, Anuj. Yeah, you're absolutely right. The market rally has been quite sharp, up move. Whatever we lost in the first 5.5 months of this year, January to June 15, 16 or so, we recovered more than that over the next 5 weeks or 6 weeks or so. So the correction in the last 1 or 2 days is a very natural outcome of this fast and furious rally. Also, in this time period, we looked at the valuation chart when the market was correcting, and towards the bottom around the mid-June part, the valuations has come down to -1 standard deviation on a forward 12-month earnings for the Nifty earning companies. And here I'm talking about the consensus earnings. And from there, it has moved into the positive territory. That means almost between average to 1 standard deviation higher. So it was only natural that some bit of correction would have happened. Now, having said that, one of the important event, which is that the corporate results has been declared, and as it should be, the corporate results should be the key driver for the market, at least for a quarter or so. For a longer term, obviously, the structural factors are more important. Now, when talking about the corporate earnings, the first quarter result, and again, I'll be talking with respect to the Nifty companies. The results were kind of mixed. Expectations were very high, and by and large, the numbers were mixed. By and large, the number were met, but there were a few disappointments also. So on one hand, there was disappointment in energy sector, but financial sector did well. Within consumption, discretionary, especially QSR and retail, did well. But on the other hand, staples did disappoint. If we look at the broader set, then the top 3-4 heavyweights, so there was disappointment there, but the breadth was reasonably good. And 2/3 of the companies either met or exceeded expectation, and that means the breadth was reasonably okay. So I would call it actually the results were mixed, but nonetheless, at the end of the quarter, there was a 3% cut in FY23 earnings and 2% cut for FY24 earnings for the Nifty companies. But I must also point out that the sales figure, the revenue number exceeded expectation, and those have been taken up for both FY23 and FY24.
Yeah,
I think
Mr. Sahai, we get your point in terms of the first quarter numbers. Now the question that we're getting, and street is a buzz about what do you do from here? At around 15,000 odd, valuations is relatively attractive. Now we have danced away to around 18,000. At these levels, I think you're a little overweight on banking names. Some of them have run up as well. So if you allocate fresh money, what do you allocate money to?
Yeah, fair enough. Yeah, and that is how also we think quite a few times actually, is that if I have to make a portfolio fresh, how should one think? Yet again, financial sector, and especially the large banks, would be my key overweight sectors, because not only the fundamentals continue to remain strong from the medium to longer term, but even in the short term, as I was pointing out, they were the key reasons for the earnings to hold up. And in the financial sector, actually, we have also seen the valuations are not expensive as compared to their history, what we are seeing in many other sectors. So to that extent, also, the financial sector is quite preferable. The other thing which has happened in the financial sector is that a bit of polarization, and the larger banks have gained market share. This trend we have been seeing for the last 2 years or so, and this trend is likely to continue. So that is definitely one sector that we will be positive on. The second one is domestic cyclical company, let's say auto sector, which has been benefiting from the cyclical upturn. There was a downturn for 2 to 3 years, but now we are in the midst of the cyclical upturn. And in case of, let's say, PVs and the CVs, we are close to the previous peak. There were few issues with the sector in the past 6 months to a year, like chip shortage and the commodity price increase. Now they are also abating. And coupled with the fact that there would be a volume growth in this sector, we do expect the earnings to surprise. So that's the second sector that we're positive on. The other thing that would be quite positive at this point of time, again, would be the domestic cyclicals, and that includes cement, industrials, and selectively building material companies, because the earnings growth that we are talking about is still likely to be driven by the investment capex in the economy. So that would be my key overweight at this point of time.
Okay. I mean, the market, I think, is sunk to a fresh low, intraday low, yeah, I mean, it's what, 17,478. This just past the 3 p.m. mark, so there's 28 minutes to go to close, and we made a fresh low at this point in time. Bank Nifty also, I think, is doing something similar, 1.8 lower, so that is sort of reaching down. And the IT index is the other one, which has been a pain point, almost down 2 now, so 1.9 to be precise. So, you know, so all sectors, at least the larger ones which were contributing to the fall, are at new lows of the day. Neelotpal, the last theme that you mentioned, industrials, you said cement and building materials. Can you talk about industrials and building materials a little bit more? Which segments there? Industrials also is fairly clear, but building materials, which sub-segments, etc.?
Yeah, there are two small sub-segments that we are quite more positive on, and that is the cable companies and the tile and the tile-related companies, which goes inside, and of course also paints as well. These are the three sub-segments within the building material that we are more positive. And of course, I did mention cement as well. So cement is also what we are something positive on. This also comes from the fact that the real estate sector also has been doing well. There have been strong launches in the past, and the construction activity is also something that we are quite positive on. So these 3-4 sectors combined together actually makes us positive on the domestic cyclical.
And industrials, anything in particular there?
The larger names, basically, in the EPC construction and the larger names.
All right. All right,
Yeah.
Neelotpal, we'll leave it there today. Thanks a lot for joining us. We're talking to you. Well, the market, just want to highlight that on the Nifty now, we're approaching a 300-point decline. So, I mean, if you thought Friday was bad, today is clearly worse. And today you've got follow through. It's now very close to that that level. The 20-day exponential and simple moving average zone will happen if we have another gap down tomorrow. And if you look at the Dow futures and the overall futures market, if you look at the European markets, it's giving you eerie similarity to what was happening in the month of June. I mean, of course, I'm not saying that we see similar fall, but at that time also, the market post that recovery after the Ukraine war saw that decline. The Nasdaq sort of topped out at the 200-day moving average, and this is very curious kind of a market. I know we keep saying that buy the dips and sell the rally kind of a market, but once the market starts to move in one direction, it sort of just does not look back. The same happened in June, and after that, from June to August rally, the market didn't give even a single reasonable dip; it just kept moving on. And in 2 days now, the Nifty has given up almost a better part of 500 points on the Nifty, and on the Bank Nifty almost 1,500 points. So just that kind of a market. We'll take a break. Up next, we'll always, as always, get you